Alright, hi everybody. In this video we're going to talk about 5 stocks for 2025. 5 stocks that are very high up on my watch list that I'm going to track very closely going into 2025, and that I will also do some more research on and probably release individual videos on some of the names at least in the future. So without further ado, let's take a look. All right, before we get to the first name, what I want to say is, and I have addressed this in many of my previous videos, the market as a whole seems, sort of stretched, sort of overvalued, overextended to some extent. And the beauty of being an active investor is that all of this doesn't really have to bother you. It may be a little harder to find attractive opportunities in an overvalued market than in an undervalued one, but it doesn't mean that you can't find opportunities in an overstretched market. And this is exactly what I'm doing and what I'm sort of articulating with this video. I think despite the high valuation you find in the US, there are still attractive names in the US and of course also outside of the US. And what I also wanted to say before I get to name number one is that this video was in a way inspired by a Barron's article in which they highlighted their 10 best ideas for 2025. I don't agree with all of the ideas there, and I would think that you can find better alternatives for some of the ideas, but there's also a bit of overlap between the names that I suggest and the names mentioned in that article. And I'll even reference one of their investment theses for one of the names that I discussed. Okay, with that out of the way, let's take a look at the first name that I wanted to discuss in this video, and this is Louis Vuitton Monet Hennessy. I think most viewers will be very familiar with this name and the offer the business provides consumers. But let's first of all take a look at the stock chart here. So as we can see, the stock has come down on a euro basis from around a price a little above 900 euros per share to a price of 630 euros. And this actually represents one of the biggest drawdowns the company has ever experienced, or that the company has at least experienced over the last 8 to 9 years. This is what you can see in this chart on the left. And the reasons for this, I think, are quite clear. It has a lot to do with China, that the Chinese economy is struggling. And as a result, the overall luxury sector has come under pressure and is sort of out of favor. At least that's my impression. And some of the names, like LVMH, were trading at very high valuation multiples, and arguably deservedly so because of the quality of these names not too long ago. But right now, and I'll share the valuation multiples of LVMH in a second, these businesses seem to trade at more reasonable valuations. What is also worth highlighting is that due to these headwinds that I think are more short-term in nature, LVMH, as of this year, isn't really growing. So what you can see in this slide from one of the investor relation presentations by LVMH is that in 2024, the first 9 months of 2024, the business wasn't really growing. And in fact, the company's revenue was shrinking by 2%. So of course, this has investors worried about the long-term trajectory of LVMH. But I think if you zoom out and take a long-term view, you don't really have to worry, because obviously LVMH has a lot of pricing power, which brings me to this slide right here. As you can see, Louis Vuitton owns some of the most prestigious brands in the world. And they own a lot of these brands. They own 75 brands in total. They refer to them as maisons. I hope I pronounced that French word correctly. If you didn't know, LVMH is of course a French name run by the French founder to this day, who still owns a material stake in the company. I think his family still owns something like 48% of the company. So that is something an investor always likes to see. And these prestige brands are also diversified across different categories. So for example, you have the wines and spirits category with names such as Monet et Chandon and Hennessy, of course. Then you have the fashion and leather goods category with iconic brands such as Louis Vuitton, of course, Dior or Fendi. You have the watches and jewelry category with brands like Tag Heuer, I think that's how you pronounce it in English, perfumes and cosmetics and much more. And I think it's beautifully illustrated by this chart infographic by Investier. I think that's an investing magazine. And what I would say investors appreciate, and what I appreciate about LVMH as well, is the predictability. I think chances are that this basket of prestigious brands will be perceived as luxurious 50 years from now as they are today. And of course, predictability is something investors appreciate, that will lead to a premium valuation multiple because investors have confidence that the company will still be around many decades from now. And that's one characteristic of business quality in my book. I just highlighted that LVMH is very diversified in terms of the different premium brands that they own. What this chart here, or this slide from another investor relations deck shows, is that the company is also quite diversified in terms of the geographic distribution of revenue. Obviously, a China recovery will be an important element for the stock's performance in the near medium term. But as I already highlighted, I think in the long term, the company will be doing very well regardless of what China is doing. And I mean, you can't really bet against China over the long term anyway. Which brings me to the last slide with regard to LVMH. What you can see here is the valuation multiples the company is trading at. And as you can see that the current EV to EBIT multiple is sitting at around 16 times, for example, which in my book certainly seems cheap. Full transparency, I don't own any of the names that I'm going to talk about in this video yet, but as I said, they are high up on my watch list and I might be a buyer anytime in the future. But as I will also stress later on, I also just like to sit on the sidelines and wait for true no-brainer opportunities. Okay, this brings me to the second name that I wanted to discuss in this video, and this is ASML, a Dutch powerhouse. And just like LVMH stock, this stock has also come under pressure more recently. It's down, I guess, something like 20-25% from the previous all-time high. I think over a 1-year time frame, the stock is actually flat. And for those who don't know, let me just briefly explain what ASML is doing. So basically, and you can see it on screen right now, ASML is developing, producing, and of course selling advanced semiconductor equipment systems for chip makers. I think that's the simplest way you could put it, because you could get into the technical details here, and I want to be quite upfront about this. I wouldn't be able to explain what exactly they are doing, the different technologies, what goes into these technologies in my own words, as well as ASML, the company itself, could. So I would just suggest to head to one of the public filings by ASML, read the business description, and I'm sure you will have a better understanding of what ASML is actually doing. And there are also amazing documentaries about ASML, the headquarters, the production facilities. So I would really recommend you to watch some of these videos if you're interested in this name. But long story short, they're basically making the systems that are required for chip makers to make chips. And what fascinates me about this company is that they are, in fact, a monopoly business that I think is as clear as daylight to most investors. Arguably, they are something like 15 years ahead of their competition when it comes to their technology. And what you can see here is also one of the machines that they are building. And just to put this into context, these machines, they are basically of the size of a school bus, and they are extremely complicated to build, which of course creates a competitive barrier for this company. What I wanted to share with regard to ASML, and I might do a separate video on ASML sometime in the future, is I wanted to share a take by Dev Kandesari, who runs the Valley Forge Capital Fund. And in an interview, he outlined, or I think this might be taken from a letter actually, he outlined his ASML investment thesis, which I think is absolutely brilliant. So let me just read it to you. Starting in the second paragraph. The companies, so that would be ASML, photolithography machines, about the size of a school bus, that's what I just said, are used to make nanometer-sized patterns on semiconductors. It's essential for the machines to perform with fidelity and precision, and significant defects and waste are unacceptable. That's why it is so hard to replicate ASML's technology. We believe its most advanced extreme ultraviolet lithography machines, which cost about 380 million euros each, may be 20 years ahead of any competitor. So there you have it. He in fact believes they are 20 years ahead. The company in high-end machines is the dominant market leader, and once machines are installed, it places a team on site and receives high-margin maintenance and upgrade revenue over the machine's life. One negative is the small number of customers, primarily the biggest chip manufacturers like Samsung, Taiwan Semiconductor, and Intel. The ability to afford new machines depends on their own fortunes, which rise and fall along with the rest of the semiconductor industry. So, and then he goes on just saying that, of course, ASML is operating in a cyclical industry. But again, for a long-term investor who has a clear idea of the long-term earnings power of the business this shouldn't be an issue. And on the right-hand side, you see the multiple the company is trading at. So on a next 12-month basis, ASML is trading at around a 30 times multiple, which is not cheap. But then again, we're looking at a monopoly-like quality business, and you might be willing to pay up for this company to get exposure to the AI trend. Which brings me to the third name that I wanted to discuss that is operating in a completely different sector, and that is CELH Holdings. My regular viewers will know that I have analyzed CELH in depth with my friend Andrew. And I would recommend you watch my discussion with Andrew next. I think we spent around 1 hour discussing the risks, but also the opportunity that comes with an investment in CELH. What I will say is that CELH clearly is a lower quality name than, for example, LVMH and ASML. I want to be very clear about that. However, what my analysis of CELH, and CELH was one of the quality stock of the month picks in my investing community, what my takeaway from our analysis is that CELH is in fact a higher quality name than I initially thought. I think distribution plays a very critical role in the beverage space, and CELH, with its partnership with Pepsi, certainly has access to one of the key players when it comes to distribution, which in itself represents a competitive advantage. And at the right price. So as of today, CELH is sitting at a price of around $26 per share. And we are getting closer to a price where I would be interested. So at the right price, I would be willing to own CELH, which I think is a slightly above average business with a long runway. So in the video, I think we also talked about the international opportunity for CELH, which is definitely massive if management can pull it off. And yeah, that's why CELH is on my watch list. And this brings me to the fourth name that I wanted to discuss in this video. And this is Evolution Gaming, that maybe not everyone who's watching my videos has heard of. This one is a Swedish company that effectively develops, produces, markets, and licenses online casino systems, so-called live casino solutions, to gaming operators. So for those who have never heard of the term live casino solutions, I would just encourage you to look up Evolution Gaming and some of the games that they have developed and then provide to gaming operators. Look for these games on YouTube to get a sense of what the company is doing. It might be odd for many of you. For me, it certainly is odd to see videos of their online games because I would never be a customer. And that's also one thing that would or could hold me back from investing in Evolution: moral considerations. So I think it's not ethical to provide casino games to customers because at the end of the day, people are losing money to this company. You could argue that in return they receive entertainment, but then there's also the issue of customers being addicted to gambling and things like that. However, what I will say is that Evolution Gaming is an absolutely fantastic business. Very high margins, insane growth over the last couple of years, certainly some stickiness that comes with being an Evolution Gaming customer. And the company is also very innovative. So when it comes to online live casino games, my impression is that this company is definitely far ahead of its competition when it comes to the quality of the games and the pace of innovation. And if we just look at the stock chart again, we can see that the stock of Evolution Gaming has also come under pressure more recently. So the stock here is probably down something like 50% from a previous peak. And this is partly due to the regulatory risk that naturally comes with operating in the gambling space. So the most recent news you should be aware of is that the UK Gambling Commission actually has launched a review. I'm just reading what this article here is saying. A review of Evolution's operating license in the UK, as the regulator has found its games are being provided to unlicensed operators in the country. So those are risks a company will always have to deal with. And that's sort of the landscape that management always has to maneuver. And that's, of course, a tricky task. And this is something earlier when I was discussing LVMH, I was highlighting that investors are appreciating predictability. And on the flip side, of course, investors don't like regulatory concerns that are always sort of a drag on the valuation multiple that a company is trading at. Because, of course, if regulators decide to do so, Evolution could, in an instant, lose access to a particular market. What I will say is that with regard to the UK market, for example, The UK market only represents, I think, 3 to 4% of Evolution Gaming's overall revenue. But then again, it may set a precedent for other regulators to follow. And that is something that investors are worried about right now. However, when it comes to valuation, if we just look at this chart here, for example, in the top right, you see that the shareholder yield, so that would be the buyback yield plus the dividend yield that Evolution Gaming is providing to investors, right now is already sitting at 7.45%. If you add this yield to the expected returns and growth rates in the next 2 years, you already see a sort of a 20% return. Now we're doing napkin math, but I would argue that Evolution Gaming is probably getting too cheap here for investors to ignore. So if you don't have any ethical considerations, I would say it's probably worth your time to take a look at this name. But then again, there are risks associated with this name. I think something to be aware of is also that Chris Meyer, the author of the book 100 Bagger, it is rumored that he actually sold out of Evolution Gaming. I think the driving factor in him making this decision, and as I said, I will have to do more research on this name as well, but I think the company has shifted its capital allocation to distributing all of their profits directly back to shareholders. And Chris Meyer, he's a very quality-focused, compounder-focused investor who likes to invest in companies that are reinvesting the majority of their profits instead of distributing them directly to shareholders. So I think if the rumors are true, this might be one of the explanations for him exiting this name. And this brings me to the last name that I wanted to discuss in this video. And this is actually the name that was also discussed in the aforementioned Barron's article, Uber. So again, you can see the stock chart here. Just like the other stocks, this stock is down quite a bit from a previous high. And I think the relatively poor stock performance is largely to be attributed to Waymo, so Google's autonomous driving solution, announcing that they're going to launch their Miami fleet without the help of an external distribution partner like Uber. And I was already briefly discussing Uber with my investing community, and someone brought up a podcast with Asworth Damodaran, so the Dean of Valuation. And in this podcast, and you can see a transcript of it on the left, this was actually shared by one of my community members. You can see that Asworth Damodaran believes that Uber's business model is fundamentally not a very attractive business model. Uber was loss-making for the most part of its history, and this is something that this community member also brought up. They have now, quote-unquote, only become profitable, that's his line of reasoning at least, due to significantly raising prices, which makes them no longer counter-positioned to traditional driving operators like taxi providers, for example. And the surplus for customers has certainly been shrinking over time. So I'm not a Uber customer, so I don't really know, but the narrative would be, and I think that's true, that Uber is no longer as competitive on pricing relative to traditional transportation providers than they were in the past. And then he was also highlighting the exploitative practices when it comes to their drivers, how they are paid, and so on and so forth, which might also be something to be concerned about. So now I was highlighting a bunch of negative aspects. Let me explain why Uber still made its way on the list of stocks that I'm going to track in 2025. So I believe that I think there's no debate about whether autonomous driving will be a thing in the future. Of course it will, and probably relatively soon. I believe that Uber has a good chance. It's certainly not certain, but Uber has a good chance to still play a role when it comes to autonomous driving and when it comes to being the key distributor and the key aggregator of demand in this space, in the AV space. I think as of today, Uber has more than 150 million users, many or some of them already being subscribers to some of the offerings, which comes with certain perks. So I would believe that both Waymo and Tesla AVs will eventually be booked through the Uber app, at least partly. I think there are probably going to be multiple providers of AVs, and I think Uber is going to play a key role in this market. And then you could argue that the transition to AVs may actually be benefiting Uber, because as we just highlighted, with human drivers, their business model might not be as attractive as it could be in an AV world, in an AV-dominated world. Because if you are the demand aggregator in the AV space, of course, that is going to be a very capital-light business, unlike the traditional transportation model that is that Uber is pursuing right now. So very capital light. That probably comes with very high margins, a high stickiness. It's almost like Uber could then be the Airbnb/Booking of the transportation space. And I would say the odds of Uber being that key player are decent. I could of course be wrong, but I think Uber definitely has a shot here, which could make Uber an attractive investment at the current price. What I should say is that investing in Uber today might also be a little more speculative than investments in some of the other names I discussed today, just because I think the path that Uber is going to follow over the next 10 years is certainly harder to predict. What I also will say to wrap up this video is that my job as an investor usually is to do very little. My job is to find high quality names, eventually buy them at attractive prices, and then do nothing. And I want to continuously remind myself, and I want to remind you as well, to be very selective in your stock picks. So those are names I'm tracking, but as I said, so far I haven't bought any of these stocks so far. Let me know what you think of this list of ideas, whether you like one of the names, none of the names, all of the names, and maybe which name you like best. Take care.